Gold just hit an all-time high, above $4,800 an ounce. The last time a single commodity moved this far, this fast, before a major financial crisis, the S&P 500 lost more than 40% of its value within the following 18 months. Right now, that same signal is flashing, and the overwhelming majority of people watching their retirement accounts and savings accounts are completely unaware of it. Here is what makes financial crises so destructive. Beyond the obvious economic damage, the warning signs are visible months in advance in public data, accessible to anyone who knows what to look for. The 2008 financial crisis did not begin when Lehman Brothers collapsed in September of that year. The mortgage delinquency data was deteriorating in late 2006. The credit spreads were widening significantly by mid-2007. Housing transaction volume had already fallen sharply before any major institution had publicly acknowledged a problem. The warning system was functioning perfectly. The data was there. Most people just were not watching the right instruments. Buffett does not wait for the crisis to become a headline before responding. He has said directly that he watches economic conditions continuously, and that when several indicators move simultaneously in a concerning direction, it tells him something that no single piece of news can. He does not predict the exact timing of crashes. Nobody can. What he does is read the environment clearly enough to know when the risk-reward equation has shifted, and to position accordingly before the fear becomes general. The people who are structurally prepared when a crisis hits did not get lucky. They paid attention to the right things earlier than everyone else. What makes this particular moment worth discussing is that right now, in 2026, 8 of the same indicators that preceded the 2008 financial crisis are showing patterns that any serious student of financial history would recognize. Not 1 or 2 of them. 8. And the historical record on what happens when this many indicators align simultaneously is not ambiguous. The pattern that precedes every major financial crisis is not random. It follows a logic. When an economy has been expanding for a long time, debt accumulates. Asset prices inflate beyond underlying values. Institutions take on more risk because the recent past suggests risk is manageable. And at a certain point, several indicators reach levels that are mathematically inconsistent with the expansion continuing indefinitely. These indicators do not cause the crisis. They are symptoms of the underlying imbalances, but because they precede the visible crash by months, they function as a forward warning system for anyone watching them. The 1929 crash, the 2000 dot-com collapse, the 2008 financial crisis, each was preceded by the same category of indicators moving in the same direction. If understanding how the financial system actually works, beyond the daily noise, is something you want more of, subscribe to this channel right now. This is where we break down what the numbers actually show, not just what the headlines say. Buffett's relationship to economic signals is that of a historian more than a forecaster. He has lived through enough cycles to have seen each pattern play out multiple times. He is not predicting the future. He is recognizing the present as something he has seen before. In his 2022 letter to shareholders, he wrote that the financial world is always offering up something that looks unprecedented on the surface, but turns out to be a variation on something he has already seen. The signals are the same. The surface changes, the underlying mechanics do not. And right now, those mechanics are producing a very recognizable configuration. Sign number 1 is the yield curve. Buffett has described interest rates as gravity for financial assets. When rates are low, the present value of future earnings is high, which pushes asset prices up. When rates rise significantly, that math reverses across every asset class simultaneously. And the yield curve, the relationship between short-term and long-term interest rates, is one of the most reliable instruments in economics for reading what the bond market believes about where the economy is heading. When that curve inverts, meaning short-term rates exceed long-term rates, the bond market is saying something specific. It believes the economy is slowing and that future rates will need to come down. That belief is priced in with hundreds of billions of dollars. The inverted yield curve has preceded every single U.S. recession since 1960, without a single exception. Not most recessions, every one. The historical lag between inversion and the beginning of the recession has typically been between 12 and 18 months. The yield curve spent the better part of 2023 and 2024 in one of the deepest inversions in modern history. That signal does not expire just because the curve normalizes afterward. The credit conditions that are damaged by a sustained inversion continue to affect business lending, mortgage availability, and corporate capital allocation for months and years after the visible inversion ends. The practical implication for you is not to try to time the market using yield curve data alone. Buffett does not do that. What he does is treat the yield curve signal as one important input in determining whether the overall risk environment has shifted. A sustained, deep yield curve inversion is a signal to examine your exposure, increase your liquidity buffer, and make sure your core positions are in businesses that can survive a significant economic contraction. The yield curve is the economic equivalent of a smoke detector. It does not tell you exactly when the fire will reach you. It tells you to stop assuming everything is fine. If this way of reading the environment is new to you, write in the comments right now, "I see what others are missing." That is the orientation that changes everything that follows. Start by examining your own debt right now. If most of what you owe is variable rate, a credit card balance, an adjustable rate mortgage, a home equity line of credit, you are directly exposed to what the yield curve was already signaling months ago. When rates rise or stay elevated while the economy slows, you pay more interest on less stable income. That is not theoretical. That is your monthly payment moving up while your financial cushion shrinks. Buffett watches how businesses are affected the same way. When the yield curve inverts and stays inverted, companies that need to refinance debt face a harder choice: roll their debt over at higher rates or cut costs immediately. Businesses with variable rate debt structures and refinancing risk show up in earnings reports first. Their margins compress, their flexibility disappears, they stop hiring or investing. These companies historically underperform significantly in the months and years after an inversion signal because they are forced to make decisions under pressure, not in advance. The second-order effect of an inverted yield curve is that the banks themselves tighten lending. When short-term borrowing rates exceed long-term rates, the economics of traditional bank lending, borrowing short, lending long, collapse. Banks cannot make money the way they have for decades. Their response is to tighten credit standards, increase capital reserves, and reduce their willingness to lend to marginal borrowers. This makes the problem spiral. Not only are businesses unable to refinance at acceptable rates, but the banks that might have provided alternative financing are pulling back. Credit availability itself contracts, not just price. Sign number 2 is credit spread widening. This indicator is less well known than the yield curve, but potentially more immediate as a warning. Credit spreads are the difference in interest rates between safe government bonds and corporate bonds of varying quality. When institutional investors are confident about the economy, they accept lower premiums to lend to corporations. When they become nervous, when they start pricing in higher default risk, the spreads widen. Think of it as the bond market's collective fear gauge. When spreads widen quickly and significantly, it means the people managing the largest pools of capital in the world are becoming afraid of corporate default. That fear shows up in bond prices before it shows up in stock prices. Right now, credit spreads on lower quality corporate debt have been moving in a direction that historically precedes credit market stress. The institutional bond market operates faster than the retail stock market. When the bond market begins pricing in distress, the equity market typically follows with a lag of weeks to months. In 2007, this same pattern played out with precision. The credit spreads on mortgage-backed securities and lower-grade corporate bonds were widening significantly months before the stock market peaked. The institutional lenders were already repricing risk. The retail investor was still seeing new highs. Understanding the sequence between credit market signals and equity market signals is one of the most practical edges available to any informed investor. When credit spreads widen, it becomes more expensive for companies to borrow. A business that could refinance at 4% can now only refinance at 6 or 7%. That difference hits profitability immediately. Companies respond by cutting costs, which usually means payroll reductions. Layoffs happen not because sales collapsed yet, but because the cost of capital moved up and the math no longer works. This is the mechanical reality. Wider spreads force businesses into contraction mode before any recession is official. Then the feedback loop starts. Layoffs reduce consumer spending power. People cut back on purchases, use services less, change their shopping behavior. Businesses that were depending on those transactions see sales slow down. When sales slow, more businesses struggle to service their debt. Spreads widen further. The cycle compounds. This is not something that happens months later. The connection between credit spreads and employment begins showing up in real data within weeks. Watch this pattern, and you are watching the financial system tightening in real time. The practical application for you is to track credit spreads as a leading indicator of employment stress before it hits the headlines. When spreads on high-yield corporate debt widen by 100 basis points or more in a short time frame, businesses in the lower quality part of the market are already responding. They are not waiting for a formal recession announcement. They are cutting costs now. If you work in a non-essential sector or your employer is in the lower quality segment of the market, rising spreads are a signal to check your financial buffer, accelerate savings, and make sure your skills are relevant in a contraction. The bond market is pricing in stress weeks before the employment data confirms it. If this is adding layers to how you see financial risk, hit the like button on this video right now. It tells me this work is worth continuing. Sign number 3 is gold at an all-time high. And to understand what this signal means, you need to understand something counterintuitive about Buffett's relationship with gold. Buffett has famously said that gold is not his preferred investment. He would rather own a productive business than a metal that sits in a vault producing no cash flow. But he has also been clear that he understands precisely what rising gold prices signal, and that when gold moves to historic highs, it is telling you something about paper money that no other instrument says as clearly. Gold hit over $4,800 per ounce in 2026. For context, gold was approximately $1,000 an ounce during the aftermath of the 2008 financial crisis. The fact that it has risen nearly 5 times since then is not primarily a story about gold. It is a story about what has happened to the currencies in which gold is priced. When gold goes up sharply relative to dollars, it means the market is choosing to hold less wealth in dollar form. It is a vote against paper, not because gold itself is producing value, but because paper is losing it. That process does not happen suddenly. It happens gradually, then all at once, in a phrase Buffett would recognize. The historical record on gold at extreme highs is that the same monetary conditions that produce those highs, excessive debt, currency debasement, declining institutional confidence in paper assets, also tend to produce financial stress within a relatively predictable window. Gold rising to historic highs is not the cause of the crisis. It is the symptom of the same underlying imbalances that create the crisis. The two are correlated because they share a root cause. That root cause is the accumulated debt burden and the monetary policies required to manage it. Look at what this signal means practically for you, not whether to buy gold. That is a separate decision based on your situation. The question is, how much of your wealth sits in dollar-denominated assets that offer zero protection if the dollar loses value against hard assets? If all your savings are in a bank account earning 0.05% interest, and the dollar has lost value at 3% annually, you are losing purchasing power silently every year. Buffett's framework is to ask, what happens if the currency environment changes? Do my assets have natural protection against that scenario, or am I purely exposed? Buffett has been explicit on inflation and currency debasement. The investor's biggest enemy is inflation, and it works on you slowly, invisibly. His response has been to own businesses with pricing power, companies that can raise their prices when their costs rise, and customers will accept it because they have no alternative. A utility, a beverage company with a global brand, a necessary business, these can protect you. Cash and bonds cannot. Gold can. But the most valuable protection is ownership of a business that compounds value faster than the currency depreciates. Sign number 4 is oil price volatility driven by geopolitical tension. Oil is the circulatory fluid of the modern global economy. Virtually every product you consume has crude oil somewhere in its supply chain. Transportation, petrochemicals, plastics, fertilizers for agriculture. When oil becomes highly volatile, especially driven by geopolitical instability rather than supply-demand fundamentals, it introduces unpredictability into the cost structures of businesses across the entire economy. That unpredictability compresses margins, complicates financial planning, and introduces the kind of earnings uncertainty that contracts price-to-earnings ratios across equity markets broadly. Buffett's approach to energy prices is not to predict them. He has explicitly said that nobody can reliably predict where oil prices will be in 1 or 2 years. His approach is to note when volatility is elevated and to factor that uncertainty into his assessment of business valuations. High oil price volatility is not a standalone crisis indicator, but when it appears simultaneously with the other signals described in this video, it amplifies the overall risk environment. Companies that appeared to have predictable cash flows suddenly have variable cost structures. Supply chains that seemed stable become fragile. The margin for error narrows precisely when the other indicators suggest the margin for error is already thin. Pay attention to what oil volatility does to your actual life. Oil moves $20 per barrel. You feel that at the pump in gasoline. Heating bills in winter. The shipping cost embedded in products you buy. Fertilizer cost that affects food prices. These are not abstract economic indicators. They are real costs that come out of your household budget every month. A 10% spike in oil affects your grocery bill, your utility bill, your transportation costs in the same month. That unpredictability makes it harder for you to budget. If you are already stretching to cover expenses, oil volatility is the variable you cannot control that pushes you over the edge. Businesses respond the same way. By making quick decisions to reduce exposure, they hold less inventory to reduce the dollar amount at risk if prices move again. Supply chains get shorter, tighter, more fragile. Suppliers that were profitable with steady volumes suddenly become unprofitable when orders drop. The efficiency that was built into global supply chains assumed relative price stability. When oil becomes unstable, that efficiency disappears, and supply chains that took 30 years to build start showing cracks in months. Buffett watches oil volatility as a multiplier on other risk signals. When spreads are widening and the yield curve is inverted and oil is volatile, you have 3 simultaneous stresses hitting business profitability. The company that could absorb 1 or 2 shocks cannot absorb all 3 simultaneously. Margins compress, hiring slows, investment plans freeze. What looked like stable earnings guidance becomes questionable within weeks. The stock market reprices these business models lower because the earnings power has declined, not because the market is irrationally pessimistic, but because the fundamental earnings capacity has genuinely changed. Oil volatility matters most when other things are breaking simultaneously. Sign number 5 is declining real estate transaction volume. This one carries more predictive weight than most people realize, and the reason is timing. House prices are what get covered on the news. Transaction volume is what economists watch. When buyers and sellers stop transacting, not because prices have crashed, but because buyers cannot qualify for mortgages at current rates, or the mathematics of purchasing at current prices and current financing costs does not pencil, volume falls first. Prices fall later because sellers resist cutting. Volume is the early indicator. Price is the lagging confirmation. In 2005, 2006, and into 2007, real estate transaction volume in the United States declined significantly before home prices fell in most markets. The volume signal was visible to anyone tracking it. The price signal came 12 to 18 months later. Today, mortgage application data and real estate transaction volume data tell a similar story. The affordability mathematics of home ownership at current price levels and current interest rates has pushed a significant portion of the potential buyer pool out of the market. That is not a prediction of a crash. It is a description of a market where the historical transaction velocity has slowed enough that price adjustment, when it comes, will find little transactional activity to support current valuations. Here is Buffett's framework. If you are a homeowner or thinking about buying right now, the question is not whether home prices will fall. Prices can move in any direction. The question is, do you need liquidity in 1 to 2 years? Are you forced to sell because you are relocating for work or your life circumstances changed? If yes, the risk is real. The market is not transacting volume, so selling might mean accepting below-market prices or waiting an extended time. If you are a long-term holder with a fixed-rate mortgage, the fluctuation in market value is noise. You are not selling, so the market price does not affect you. Your monthly payment is locked. You are fine. The choice to sell should be yours, not forced by circumstance. Pay attention to the real estate market as a window into broader financial stress. When transaction volume falls sharply, it does not signal that the market is calmly preparing for adjustment. It signals that potential buyers have disappeared because the financing math no longer works. That is forced behavior, a rational response to numbers that do not pencil. When that pattern is present simultaneously with inverted yield curves and rising credit spreads, you are looking at a tightening credit environment that has begun to restrict entire categories of financial activity. The person who could buy a house 2 years ago cannot buy today at the same prices. Not because they are less interested, but because the lender will not provide the capital at current rates. That is the signal. Sign number 6 is rising credit card delinquency rates, and this is possibly the most direct window into the actual financial condition of American households available in public data. According to data tracked through the major card issuers' earnings reports and Federal Reserve consumer credit data through 2025, credit card delinquency rates rose approximately 30% compared to the prior year. A 30% deterioration in delinquency rates is not a rounding error. It is the kind of move that historically precedes either a sharp contraction in consumer spending or a significant uptick in personal bankruptcy filings, or both. Buffett has described consumer credit health as one of the most honest thermometers of the underlying economy. The logic is simple. When people miss credit card payments, they have exhausted their options. They paid the rent, they paid the car, they bought groceries. The credit card minimum was what was left over, and there was not enough. By the time the delinquency shows up in a quarterly earnings report, the household has typically been under financial stress for 6 months to a year. The official economic data lags the lived experience by that same 6 to 12-month window. By the time an economist calls a recession, the households showing up in the delinquency data have been in their personal recession for a year already. The historical parallel to the 2007-2008 period is direct. Credit card delinquency rates began rising in early 2007 before any major financial institution had publicly acknowledged the severity of the subprime mortgage deterioration. The consumer financial stress was visible in quarterly earnings reports from JP Morgan Chase, Citigroup, and Bank of America months before the equity market peaked. The same data is available today. The same trajectory is present. When more than 30% more Americans than the prior year are failing to meet their minimum credit card obligations, the consumer buffer that has been sustaining GDP growth is thinning faster than the headline numbers suggest. Listen to what this means if you are carrying credit card debt right now. If you have a balance at 20% or higher APR while delinquency rates are rising broadly, you are not observing the warning sign. You are part of it. You are in the same financial category that the data is measuring. Take $5,000 of credit card debt at an APR of 24.7%. That costs you $1,235 per year in interest alone. That is money you cannot invest. That is compound growth that should be working for you, going to the bank instead. That is the panic premium, the extra margin the lender charges because they are correctly pricing in that you might not pay. If delinquency is rising, that premium is about to move higher. Sign number 7 is the dollar weakening against other major currencies. The dollar's role as the world's reserve currency means that most international trade is denominated in dollars, most commodities are priced in dollars, and most central banks hold significant dollar reserves. When the dollar weakens in a sustained, structural way, not because other economies are booming, but because global confidence in the dollar as a store of value is declining, it signals something different from a routine currency fluctuation. It signals a repricing of the long-term creditworthiness of the United States government and the long-term purchasing power of the paper it issues. Buffett has spoken carefully about the dollar. He expects it to remain the primary reserve currency for his lifetime and holds the vast majority of his wealth in dollar-denominated assets. But he has also been explicit that the United States cannot run the kind of deficit spending it has maintained for decades without consequences. A weakening dollar, occurring simultaneously with elevated commodity prices, rising credit spreads, and record gold prices, is not an isolated event. It is a corroborating data point that the same underlying monetary stress is being reflected across multiple independent asset classes at the same time. When all the instruments point in the same direction, the probability that they are all wrong simultaneously is very low. What does a weaker dollar mean in practice? It means the price of everything imported goes up, oil gets more expensive, manufactured goods cost more, the real purchasing power of dollar-denominated savings declines. Buffett's response to this has always been consistent. Hold assets with natural inflation protection, businesses that can raise their prices as costs rise, real estate, commodities, equities of companies with pricing power. Avoid pure cash and bonds denominated in a currency that is depreciating. Bonds paying 3% return look very different if the currency is losing value at 3 or 4% annually. You are actually losing money after inflation. The portfolio question shifts from maximizing returns to maintaining purchasing power. A 10% stock gain means nothing if the currency in which your stock is denominated has lost 15% of its value. Buffett learned this through decades of watching inflation cycles. The investor who focuses only on nominal returns and ignores currency debasement gets crushed silently. You make 8% in your portfolio, the currency loses 10%, and you are worse off than you started, not ahead. The weakening dollar has one more practical implication that affects you immediately. Foreign companies raise their prices in your local currency. A Japanese car manufacturer selling into the United States market must now price its vehicles higher in dollars to maintain the same yen-based margin. A European luxury brand has the same choice. The dollar weakness gets passed through to the consumer as higher prices. Combined with the other 7 signals, tightening credit, rising commodities, consumer stress, a weakening dollar amplifies the inflation pressure at the exact moment when consumers have less financial flexibility to absorb price increases. This is not theory. It is mechanical. Weaker currency plus tightening financial conditions equals higher prices for the consumer whose real wages are not rising. Sign number 8 is central bank gold purchases accelerating worldwide. This is the signal that receives the least mainstream coverage and may carry the most structural significance of all 8. Central banks, the institutions that issue and manage national currencies, do not buy gold because they think the price will go up. They are not speculating. They buy gold because it is the one reserve asset that cannot be defaulted on, cannot be frozen by a foreign government's sanctions, does not carry counterparty risk, and does not depend on the creditworthiness of any other institution. When central banks move toward gold, they are hedging against the fragility of the paper currency system, including, in many cases, the currencies they themselves issue. According to World Gold Council data, central bank gold purchases reached record highs in 2023 and continued at historically elevated rates into 2025 and 2026. The buyers are geographically and politically diverse: China, India, Poland, Turkey, Qatar, Singapore, and numerous sovereign wealth funds across the Middle East and Asia. This is not one country responding to one political situation. This is a broad, coordinated, institutional move away from dollar-denominated reserves toward hard assets, happening simultaneously across dozens of different governments and central bank mandates. When the people who create money decide to hold less of it and more of something that cannot be printed, that is a statement about what they believe the money is actually worth. Unpack what this signal means in plain terms. Central banks do not speculate. They do not buy gold, hoping the price will go up next year. They buy gold because it is the one reserve asset that cannot default, cannot be frozen by sanctions, and does not depend on another country's promise. If the institution that issues your currency is buying hard assets instead of holding its own currency, you should ask yourself a straightforward question. What do they know that has not made it onto the front page? Not conspiracy. This is documented public in their quarterly reports. Central banks are hedging. Hedging means they are pricing in the possibility that the paper system they manage gets stressed. That is what you are looking at. What this means practically changes the portfolio question fundamentally. It shifts from trying to maximize returns in the next bull market to asking, what happens if currency stress becomes real? How do I preserve wealth through that scenario? The institutional players who manage trillions have already moved. They bought gold, they own hard assets, real estate, commodities. They are no longer purely exposed to paper. The question for you becomes whether you follow the same path, at whatever scale matches your situation. Buffett has said that when you see extraordinary things happening across multiple asset classes simultaneously, the right response is not to panic. It is to assess. These 8 signs are not a guarantee that a crisis begins on any particular date. They are 8 independent instruments, each with strong historical records as leading indicators, each currently in a configuration that has historically preceded significant economic disruption. What Buffett's career demonstrates is that the preparation for a crisis is not done during the crisis. It is done before, when the signals are visible, but the fear has not yet become universal. The gap between seeing these signals and doing something about them is where most people stop. They understand the risk intellectually. They do not restructure their financial lives in response. Buffett's framework for this gap is the same one he has applied for 70 years. You do not need to time the market perfectly. You need to ensure that your financial structure, your liquidity buffer, your debt exposure, your investment mix, your core positions, can survive a sustained period of significant disruption without forcing you to make decisions under duress. The preparation does not protect you from the crisis. It protects you from being one of the people who panics when the crisis arrives, and in doing so transforms a temporary decline into a permanent loss. If you stayed until the end, write in the comments, "I am paying attention." There is another video ready for you on screen right now. The next step in understanding how to position yourself before the next major financial shift. Thank you for watching. We will see you in the next one.